Okay.
Yeah, Jim, the floor is yours.
All right, let's go ahead and start. Welcome to the Accounting Design Project Workshop Series. Hello, everybody. My name is Jing Pan. I'm an assistant professor from Penn State. Today, we are very excited to have James from American University to present the goodwill impairment after merger acquisition level evidence. Just a few housekeeping items before we start. First, I'd like to remind you to stay muted unless you have a question or making a comment. Ideally, if you are comfortable, please turn on your videos. For comments, you can either use the raise hand function by clicking participants at the bottom of the screen, or you can use the chat box to type your comments. I will call on the participants in the order. We would like to give James the first 5 minutes uninterrupted and the last 5 minutes to conclude. All right, James, take it away.
Okay, so the paper is all about goodwill impairments, which is, I think, a topic that piques a lot of interest among accountants, and is co-authored with Jake Thomas at Yale, who I believe is somewhere in the audience. So a little bit of background on goodwill, just so that we're all on the same page. Goodwill is formed as the result of mergers and acquisitions. It's going to represent the purchase price above and beyond the sum of the market value of the individual net assets purchased. So the idea is there may be some synergies, or there may be some assets that are just not valued by the accounting system that do show up in the purchase price, but we're not directly picking up as other types of assets. It could also be that there's some sort of overpayment driving this goodwill, but we'll leave that to kind of later part of the paper. Before 2001, we had APB 17 or SFAS 121, which required firms to amortize goodwill and check for impairments. With 2001, we have a shift in the rules. We moved over to SFAS 142, which is now known as ASC 35020, which eliminated the amortization of goodwill, but requires regular tests for impairments. As part of this shift in the rules, there was also the elimination of the pooling option for how you represented mergers or acquisitions. And so there's a few different things that were changing with this 2001 rule change. Finally, the impairment test for goodwill does leave significant discretion in the hands of managers. So a lot of it is going to rely on certain estimates and assumptions. And so this is a little bit of a criticism of what's going on in terms of goodwill. It's because managers necessarily have a lot of input here, and there's a chance that they use their discretion opportunistically. So a little more background, there is very much a rich and extensive literature on goodwill impairments. We argue in this paper that the existing research focuses on two extremes. One, as you can see on the left, is rejecting the null of zero compliance with the rules. So a few examples, and this is definitely not meant to be a comprehensive list. If you looked at our paper and saw how long the works cited list is, you know that there's a lot of material in this area. We're just picking out a few examples because I wouldn't have enough room on the slide to include them all. So Banker, Basu, and Vaslov, 2017, Jarva, 2009, as well as Lee, Schroff, Ventakaraman, and Zhang 2011 are all examples of paper that basically reject the null of zero compliance. We also have a few papers out there that reject the null of full compliance. For example, Romano Watts 2012 or Lee and Sloan 2017. And I'm going to go into a little more detail about some of these papers later on in the slides. But just to give you an idea, we kind of have a lot of research that either says, you know, we're rejecting zero compliance, we're rejecting full compliance. And basically what we're trying to answer in this paper is where in between these extremes does compliant with the goodwill impairment rules lie? So where are we between rejecting the null of zero compliance and rejecting the null of full compliance? So we feel it's not entirely clear, and what we're trying to do is help out policymakers and the users of the financial statement figure out kind of where in between things are to see whether or not these rules are helpful or whether they can be improved. Also, what we're trying to do this paper is that given the significant number of goodwill impairment models out there, we're trying to figure out what's useful and cost effective in terms of research design for future research. There's a lot of hand collection that goes into all of these models. And so what we're trying to do is help inform future researchers about what's helpful, what can be done to improve the models, and where you don't necessarily not need to put a lot of time and effort into doing things that are related to hand collection. Having done a lot of the hand collection ourselves, we know this is an exhausting and tough process. And so we're trying to help future researchers be a little more effective with their time. So a summary of our findings, I realize there's a lot on this slide. After this, please feel free to ask questions. So the summary of findings, we're looking at where in between the extreme does compliance with goodwill impairment rules lie. Overall, we believe there are high levels of compliance, and we don't find particularly much opportunism. Admittedly, we do take a somewhat broader view of compliance than some might agree with. We believe that firms experiencing signals that they should impair but do not are following the rules if the signals they're receiving are temporary. Our analysis indicates that most transactions that are labeled in one period as should impair, but firms choose not to, are either experience a temporary aberration in firm performance, or they impair quickly in the future, though not necessarily the same period. The idea for allowing these temporary deviations is consistent with managerial private information, as well as investor overreaction, and more generally with how the SEC approaches this thing. So at the end of the presentation, we'll go through SEC comment letters, and I'll highlight a little bit about how the SEC seems to be okay with situations where managers are arguing that they're not impairing because the performance declines are temporary. If the readers disagree with our 85% compliance rate, we do provide detailed data to allow them to develop their own compliance rate. So admittedly, the 85% number that we highlight in the paper is based on a specific set of assumptions. And so we're providing a lot of disaggregated data to allow the reader to kind of put together their own compliance rate if they disagree with our approach. In terms of what's useful and cost-effective for future researchers in developing models for goodwill impairments, we highlight that the market-to-book ratio just above 1 are still associated with goodwill impairments. So there's a lot of valuable predictive power in market-to-book ratios that are just above 1 that have kind of been ignored by prior research, and we think they add a lot to the models, and we'll kind of show you why we think they add. Also, segment-level data we surprisingly find is not particularly relevant. And so given the high cost of hand collection in those areas, we're hoping that we've kind of signaled to researchers that there's a lot of things that need to be hand collected. Maybe segment level data is not the most necessary or helpful thing given this area. A little bit about our approach. We're going to use hand collected data to track 893 large acquisitions for a 10-year period. We were going to build off the goodwill impairment model in Hain and Hughes 2006 to form a comprehensive model that incorporates both acquisition date data and post-acquisition variables. We're also going to include a lot from other papers. As noted, there's a rich literature here, and so we try to pull in as much as possible from other papers to have as comprehensive a model as is feasible. We're then going to use the model to classify transaction year observations as should impair. And starting with the first instance of a transaction being categorized as should impair, we're going to track compliance based on how a firm proceeds in that year, as well as the following 2 years. Yes, Ayala?
So James, will you talk about how do you actually end up with 93 acquisitions and how many unique or distinct firms represented by those acquisitions?
I'm going to jump ahead a little bit because I do have a slide on this. Admittedly, we start with a much larger group to begin with. So if you look at SDC, we're taking all US acquirers between July 1st, 2001 and the end of 2009. So that would end up with about 14,500 transactions or so. We're then going to subtract out transactions that have a value of less than 5 million. We're worried about materiality here, both in terms of having the asset allocation numbers that we need for our model, as well as kind of materiality of impairments going forward. So whether the goodwill impairment would be something that would be recognized and highlighted and disclosed in the system. We also make some adjustments if the acquirer is not a majority owner post-acquisition, or if the stock price of the acquirer is below 5. We're worried about penny stocks. We're using some market returns data. And so if we have such small numbers, we're worried that's going to create a problem. So that gets us down to about 5,600 observations. We drop another 240 that SDC describes as undisclosed or individual assets. We're looking for companies that are being acquired as targets, not individual assets. And we remove anything that's a mutual fund or a REIT. They have their own kind of rules. Also, REITs are unlikely to have any sort of goodwill associated with them. That gets us down to 1260. We do have an issue that some transactions just don't have allocation data provided by the acquirer, or there's no financial statements on EDCAR for that acquirer. Most of the time, what's happening with those 204 is a materiality issue. Those tend to be much smaller transactions compared to our final sample. And so we feel like it must be the case that these acquirers just don't concern themselves with these transactions because they're relatively small. Finally, we do have 163 instances where it's unclear if an impairment is related to acquisition or there's some data availability issues. We did look into these in more detail, and most of them do seem to be highly related to materiality again. And so we end up with 893, and 222 of these are going to end up impairing. I think I also mentioned, what does it look like in terms of the acquirers? Most of these are individual acquirers. Most of them are just one, but we do have instances of multiple acquirers. We have one interesting outlier that bought 13 targets over the course of these, 9 years or so. So there are definitely some multiple transactions here for the same acquirer. They tend to be either in tech, pharmaceuticals, or finance. That tends to be companies that buy a lot of other firms. But for most of the sample, it's kind of just one acquisition per acquirer. Does that fully answer your question, Ian? Okay. So prior literature, I know there's a lot of people on the call and a lot of people who have probably worked in the goodwill area. In trying to cut this down so that I can give a discussion in an hour, I have greatly reduced the amount of prior literature we're going to cover, and it's just going to focus on the few ones that we mentioned earlier. This is not meant to be a comprehensive list. Rather, it's meant to be kind of brevity is important given how much we need to cover. So we're building on a big body of existing literature, and our model is mainly based on Hain and Yu's 2006, which showed that both acquisition and post-acquisition data is associated with goodwill impairments. They're going to focus on pre-2001 data. They do have a very small bit of analysis, which I believe is either a footnote or at the very end of the paper, where they take a look at some data post-2001, but really they're focused on the prior set of rules there. In terms of evidence of noncompliance with our current set of rules, so kind of 142 or whatever it's been relabeled as under the new codification, we have Romana and Watts 2012, and they have a really neat paper that argues that the post-2001 rules are likely to be ineffective because of managerial discretion. And they provide some empirical evidence consistent with delayed impairments despite market to book below 1. So they're arguing if you have multiple periods where your market to book is below 1, you must be doing something wrong because the market's telling you that you need to impair. Lee and Sloan 2017 is also looking at delayed impairments. Again, they're arguing that managers have a lot of discretion over the impairment calculations, and so they're going to use them to delay impairments. Specifically, they find that firms with overstated goodwill are more likely to have future impairments and negative future returns. And I think the really neat part is they show that these results are much stronger when agency costs are higher. So the cross-sectional tests are consistent with managers kind of opportunistically using these impairments. That said, these are just 2 papers. There's also a bunch of results that show compliance or mixed results. including Jarva 2009, which showed mixed results on compliance. So goodwill impairments are associated with lower future operating cash flow, but this is not the case when there's concurrent restructuring charges. So the Jarva paper is arguing that there's big bath style opportunism here. So generally there is compliance, but when you have restructuring charges, managers are using this as an opportunity to take a big bath. The second paper on the list, Lee, Shroff, Ventakaraman, and Zhang 2011, is also providing mixed results. So they find that goodwill impairments are associated with more negative returns, as well as declines in earnings and sales growth, but it's also significantly related to overpayment, which indicates something structurally wrong with the transaction. Next, we have Banker, Basu, and Baslog 2017, and they're going to use multiple measures of post-acquisition performance that account for conditional conservatism. So we're going to use their idea in our model as well. They break down performance into performance increases and performance decreases, or kind of gains or losses, things like that, to make sure that it makes sense that the impairment rules, which are sort of based on conditional conservatism, are followed through in the research design. And they find that the trigger for impairments is more negative than assumed by prior studies. Finally, we do build on Wanger in 2019, which shows that due diligence is associated with the odds of impairment. So we control for the Wangerin measure in our research design as well. Okay. So it's fair to ask, how exactly is our approach different? If there's so many papers out there on goodwill impairments, what is the point of this paper? First, we're here to help regulators and financial statement users because we're looking at exactly what compliance is. So we're not here to say everybody's not compliant or everybody's compliant. We're trying to figure out where in the middle things lie. And we hope that that's going to provide useful evidence in this ongoing debate about whether the current rules are working. So while it's the case that FASB seems to have decided to not make any adjustments to the rules, there was quite a robust debate about how best to approach things. And so we're hoping that if these debates come back, which they seem to come back every few years, that will provide some helpful data here. Yes.
Hi.
Hi, Anne.
How are you?
Good. How are you?
Good. One thing that I wanted to add is the IASB just put goodwill finally on their agenda.
Oh, thank you.
And one of the things that they put on their agenda was examining increased acquisition-specific information. So that's a big concern, is not just goodwill balance overall, but the idea that investors want to say, did you make a good or a bad acquisition? And I guess when I saw your paper, I thought it was really fortuitous for you. They just put this on their agenda, and I feel like you can speak to that in a way that I don't think has been done in previous work. I do think it is complicated by the fact that, as you said, there are lots of other non-material, kind of undisclosed, without the purchase price allocation, et cetera. But I believe that what they said they wanted to do was actually to focus their attention to the large material ones, with the appreciation. I mean, you said some of them had 13 in the whole period. Some of them have 13 in 1 year, except there's only 1 or 2 of them that they actually disclose, and then they have a bunch of little ones that they group together and say are immaterial. So I think it's challenging to tie it to an acquisition, but I feel like the approach that you're taking actually fits right in with the information that's being requested by the equity community and by what's in the IASB agenda item.
Thank you very much. I'm thrilled to hear that kind of another regulatory body is interested. I have a feeling that FASB will probably return to kind of their discussion of goodwill at some point, but it's nice to know that this can provide evidence for kind of the international standards. Also, Anne brought up one of the banes of my existence during data collection here, which is that admittedly for some of the transactions, the asset allocations were merged or deemed immaterial. And so after kind of going through all the work of finding the proper financial statements, sometimes it was quite a pain to realize that you weren't going to get the details in the asset allocation that you anticipated. So for those of you who are pondering hand collection, just a warning that is going to happen sometimes. It does mostly seem to be related to materiality, but it is a little disappointing if you or your team of RAs has to kind of deal with that on a regular basis. Sorry, Ayang.
Yeah, so like related to kind of like your discussion with Anne is that it seems like this transaction or deal level disclosure is relevant for material M&As, right? And I think I want to hear more your thoughts on what's material. How do we identify material? It may be a little off track from your paper, but recently I think there's a workshop at Georgetown, and then this group of researchers from Notre Dame claim that about 76% of the material M&As are not filed with AK, with SEC, and then they claim that it's a lot of material deals are not complied with disclosure. But in your simple construction, you use $5 million, right, cutoff. So like, can you elaborate a little bit more about why you chose that, and then how do we get at what will be the targeted M&As that's will be benefit from this transaction level disclosure? Yeah.
Right, so admittedly, we chose kind of a dollar value to limit things because that was an easier way to kind of compile the data compared to a percentage of assets of the acquirer or something like that. So the issue we ran into with using kind of a $5 million level was that for some of our largest acquirers, it admittedly created a situation where some of their transactions would be relevant for a tiny acquirer, but are going to not be material for them as a larger firm. And so admittedly, this is more just kind of data availability driven on our end. But we did notice kind of a materiality issue. So we have a bunch of footnotes in the paper about kind of why we weren't able to get all the transactions. For most of those, we've kind of focused on the size of the transaction in terms of just dollar values overall, and they are going to be much smaller. However, it is the case that we see kind of a similar issue if we use a percentage of, the purchase price divided by the size of the acquiring firm. And so it would be kind of nice to get more details, and it was very disappointing to see these firms kind of ignore what are substantial transactions, but I guess they view as not material. Other times what's happening is that there's a combination of allocations across multiple transactions. So they view the transactions they have during the year as one material event, and they merge across the three. For kind of the research design that we have and what questions we're trying to answer, we have to kind of eliminate those because we can't, parse out by transaction what's going on. And so that is a little frustrating, and hopefully something we'll see improved upon, I guess, under the international rules. It'd be nice if FASB considered that too. Okay. So I think we went over a little bit about the first bullet point here. And so for the second, to help future researchers, we propose and kind of test the usefulness of two expansions to the typical goodwill impairment model. So we look at market to book and we look at segment level data. With market to book, we're asking, is one really the benchmark? And so this is what's typically used in prior papers. And there's a lot of reasons for doing this. Theoretically, it's the cleanest setting because here the market is telling the company that something is overvalued. And given the size of goodwill on most firms' books, it's a good indication that goodwill is what's quite overvalued. So theoretically, there's a good reason to consider that. But the reality is that there are temporary aberrations of stock price. There are issues with managerial private information. And so maybe we should consider market to books that are a little bit over one. There might be some predictive power there that we should take into account. Second, we're looking at segment level data. This isn't something that's highlighted in a lot of other papers, but the reality is it is very costly and time consuming to get this sort of data. Tracking a transaction, worrying about segments that might change names is going to be quite difficult. And so it's fair to ask, is the hand collection process worth it? Is it the case that this offers superior ability to kind of associate with goodwill impairments? And so we look into that in detail. There's a third thing that we do, which is basically highlighting the value of hand collection in general. And so I don't cover this much on the slides, but we would like to highlight there is huge value to doing so. And the most striking thing is that we would basically double the number of impairments we would have relative to transactions if we just assumed that whatever the CompuStat value for goodwill impairments was represented what happened to a given transaction. So it would go from about a quarter to 50%, which I think is a staggering difference, which tells us that in this area of the literature, we really should be hand collecting to understand what's going on at the transaction level, because a lot of the times that's going to throw things off. Yes, Shelley?
James, in terms of to help future researchers to build this goodwill impairment model, have you looked into whether it's helpful to add like SEC common letters into the model? Because like the prior literature, when they built the goodwill impairment model, I think the SEC common letter was not widely available, but now it actually is. And I know goodwill is more or less a frequent topic in these common letters. So I don't know whether you look into like with your 85 versus 15%, are the 15% more likely to receive common letters or not? Like, are there any predictability in your sample in that way?
Yeah, so there is huge value to the comment letters, and I promise to go into detail about this. Rather than incorporate it directly into our model, we use the comment letters as sort of a validation test. The reality is with these models, we're saying the benchmark is relative to the rest of the sample. And so we were looking for more of an absolute benchmark. And so we do use the SEC comment letters about goodwill to help validate things. And we do find that if our model indicates you should impair, it is very much associated with these SEC letters. And there's a bunch of other details that I'll get to kind of later in the presentation, explaining that those do have quite a major effect and can be used. There's also a lot of neat data if you get to, or sorry, a lot of neat things to pull out of letters if you have a chance to read through some of them. It does kind of go to the SEC's thinking on how to treat goodwill impairments and what they're concerned about when they're looking at firms. But we can at least say that our model very closely aligns with the kind of SEC's investigation of firms regarding goodwill. Okay. Since there is a major line of literature on this, not surprisingly, our goodwill impairment model is going to be quite significant. So there's a lot of variables. We build off the kind of Hain and Hughes 2006 structure, but we add from a bunch of different papers. So the overall idea here is our goodwill impairment model is a hazard model. The dependent variable is going to equal 1 if a transaction is impaired in a given year. Once a transaction impairs, we drop it from the sample. Admittedly, we take a kind of all or nothing approach here. It's the first time a firm impairs. We're worried about that rather than the amount of the impairment or anything like that. But I'll come back to that topic later when we're looking at the descriptive statistics. So we have a hazard model. What are the independent variables? So on the left side of the slide, we have the post-acquisition performance. And at the very top of the list is all of the market to book related variables. So generally, prior papers use either market to book as a continuous variable or market to book less than 1 as an indicator. The idea is those are kind of a powerful test for whether or not there's going to be a goodwill impairment. What we're adding here is indicators for market to book between 1 and 1.25 and between 1.25 and 1.5. So what we're concerned about is maybe there are some differences across segments. Maybe there's some things that aren't showing up in our traditional measures, so we're expanding that a little bit. Bunch of questions.
So we have Oliver first and then Steve.
Hey, James, just a question regarding the prediction model here. So, I mean, right now you kind of call it a prediction model, but it's not really implemented as a practical one, right? So, I mean, like to me, it seems like it's very much focused on in-sample prediction right now. Have you guys thought about kind of conveying that into an out-of-sample prediction model and then really producing something that would that practitioners could use in real time, given that so much of your motivation is relying on practitioners and standard setters learning from what you do?
So admittedly, that's how all of the main analysis is presented. We did consider that in two ways. So we have two out-of-sample approaches. The first is basically we ran the model on kind of the first half of the dates in our sample and used the coefficients there for the second half, and we ended up with very similar findings. Kind of the coefficient significances all look the same. Kind of the outcomes that you see at the end of the paper when we're kind of using that to predict should impair, all of that looks very similar. And we did the same thing by basically randomizing which ones are in versus out of sample. And again, our results ended up very similar. So we ended up sticking with this admittedly kind of just treating everything the same approach, simply because the other two gave us the same thing. And here we could at least maximize our hand-collected observations. But that is a very fair question, and I should be a little more careful about calling it a prediction model because the main results admittedly are not a true prediction model.
Yeah, however, I mean, when you come from the earnings prediction literature, you know, like I've mainly worked in that, and there I think we mean something very specific with a prediction model, right? So you would really predict earnings, and then you would compute like an absolute forecast error. So what you're describing, that's not what you have done here, and also not in the test that you just described that you haven't tabulated. I mean, which would involve basically identifying firm out of sample as either a firm that will impair or not, and then kind of computing the ratio of like your type 1 and type 2 errors, basically, right? So it wouldn't be about coefficient estimates anymore. It would literally be about saying, look, this firm is going to impair, and this is not going to impair, and then just seeing like, you know, how many times are you actually correct with this, right? So, but again, I mean, it might be terminology here, but again, if you kind of talk prediction, then someone coming from that literature would expect something different.
Yeah, that's a very fair point. So I'll kind of discuss with Jake whether we can see if there's any kind of relevant test. I do need to be a little more careful about the terminology I use. So thank you for that.
James, it's Stephen Penman here. This price to book as an indicator below 1 or 1.25, you go for higher bounds. It seems very strange to me. A lot of the big acquisitions are made by pharmaceuticals, and their price to book, you know, a 5, 6, 7. Coca-Cola's made some acquisition recently. Their price to book was what, 9 or 10? So it doesn't seem to be a good filter to me. And the reason, of course, is most of their assets are off the balance sheet. Apple has no net assets except cash. So it doesn't seem to be a sensible filter at all. Have you got a response to that?
I think it is going to have some variation depending on industry. As we know, our accounting rules are better at grasping certain industries compared to others. I think, you know, when it comes to manufacturing, the accounting rules are great. When it comes to firms with a lot of intangibles, I agree with you that there are some significant limitations with how things are set up. What we're hoping is that by creating a very extensive model with a bunch of controls, we can kind of have those controls apply to some of these other industries. And for where market to book is going to be most relevant, we're hoping the model kind of picks it up if there are a preponderance of firms, which this is a good enough measure for. And I think what we're finding is that for enough firms there, this is going to be useful to look at. So we're not denying that for some industries, market to book has so many limitations that maybe it's not going to be useful. But it might be a good thing to kind of highlight in the paper that there are some limitations and kind of think a little bit more about how industry is going to play a role here. And
I guess I just wanted to chime in and say it is the rule, though. So it depends a little bit on whether you're trying, because you talked about, do firms comply with the rule or don't they comply with the rule? And do they use discretion, etc.? So in terms of it being useful to investors, it could not be useful at all. But firms could still be in compliance with the GAAP rule or the IFRS rule. I guess it depends a little bit on how you want to pitch your paper. Who's the intended audience of the paper, and what are you trying to achieve in terms of, are you trying to say, well, this is a really stupid rule and you should do something different, or what is it that you're trying to do? Do you know what I'm kind of getting at?
so I think our attempt is to focus on whether firms are complying with the rule. And I think you have kind of a good point. Whether the rule is terrible or not, we are not entirely, staking a position on. I think here we're just trying to say, is it the case that firms are complying with the kind of existing goodwill impairment rules? Alina?
Hey, James. So first of all, Anne just voiced what I expected you to answer as well. Again, if your question off the bat was compliance, and it's going to look different for industries, but just kind of to prevent you from going further, since you are, this market to book really comes out, I think, as a punchline for you guys from the paper. So one thing that I was wondering about that you don't really speak to, as far as I can see, when there's multiple potential impairments which the company is facing, there is an order that GAAP prescribes, and goodwill is going to come last. So if you do have a triggering event, you are required to look at the tangibles and the other intangibles, which, if they happen, are all going to bump the book value, right? So which is in fact going to make the goodwill impairment test easier to pass. So I wonder if there are firms, and again, this might be a subsample of firms, which essentially, they look like they are technically in compliance because the bar has just been reset for them because of the other things that they're following, but the unit is still going to underperform. So I kind of wonder if it's going to be even, if you could make this even better, because again, this, there is a numerator and denominator here. So the market to book is a little bit of a moving target. So you need to fix the book one and kind of treat those as maybe different situations or different samples.
So we did consider a little bit and admittedly at the very end of the paper about what's going on with other write-downs. And so we do find the year of, there does seem to be kind of write-downs both at the kind of goodwill section as well as for other assets. But I think we haven't dug too deeply into that, and that's a very kind of neat idea to explore. Need to kind of do a little more on that. Okay, so a little more about the model. We also look at current period performance. So for that, we look at ROA, both this period and lagged. We look at the change in sales as well as the lag change in sales, the raw returns over the current fiscal year. So this is a little bit different from some of the other papers. We're arguing that just because other papers are using industry adjusted returns, we don't think that's necessarily the most appropriate in this situation, because a firm should be impairing not relative to its competitors, but if it has a decline in performance overall. And so that's why we're focusing here on raw returns rather than industry adjusted. Oh, Ayang?
Yeah, hi, James. Your conversation with Anne and Stephen kind of like made me think about that. Can you report your out of sample prediction kind of like error across industry. So if Steve was right, is that for intellectual property heavy industries, this market to book around 1 may not be a sensible filter, then does that kind of like correspond to your forecast error out of sample across different cuts? That would be kind of interesting, descriptive, right?
Sounds like a great idea.
Yeah. In terms of the compliance, still focus on the compliance focus that your response to it.
Yeah, we could delve a little more into kind of the industry aspect of things. That'd be interesting. Thank you. And finally, regarding our post-acquisition performance, we do disaggregate each of our performance measures, the ROA, the change in sales, and the returns into positive and negative components, following the Banker et al. 2017 approach of considering the conditional conservatism. Steve?
Yeah, just on performance, you know, it's almost automatic that the profitability falls after an acquisition because you get the earnings from the acquiree, but the book value goes up tremendously. So it's actually almost every time a performance does perform drop. That doesn't matter much because from a valuation perspective, because you have lower ROA, but you have the value in the balance sheet. But ROA always falls. It has to.
No, so that's definitely a relevant point. So for our sample, since we're restricting it to all acquisitions, I'm hoping that we kind of avoid that concern because everybody in the sample should have acquired another firm. And we do control for size. So I guess empirically, does that?
Well, it depends on how much comes onto the balance sheet. I mean, if you have if it's a very big acquisition, a lot comes onto the balance sheet, and the ROA, for example, of let's say Procter & Gamble acquiring Gillette, that way back there, their book rate of return was 28% before the acquisition, drops down to 12%. It has to, because you got all that stuff coming onto the balance sheet. That's just how a probability works. And profitability by itself, therefore, is not a measure of performance. That's sort of a standard thing in financial statement analysis. Profitability is not a measure of performance because it's affected by how much you have on the balance sheet.
So would you suggest more of a profit margin approach to performance?
Yes, I think of sales growth and profit margins, and profit margins coming out of the sales growth. But you've got to be careful bringing the balance sheet into it because that's where all the stuff goes on.
That is a fair point. I admit on kind of this section of the paper, it's kind of following prior literature. We're reusing a bit of the Hain and Hughes approach, and they're kind of relying on ROA, but we should at least, I think, consider switching that or running a robustness check. I think that's a good point. Yeah,
it's sort of a standard error that people think of profitability, accounting profitability as being profitability, and it really is not. It depends on how you do your accounting, whether you've got assets on the balance sheet. It also depends about how much R&D and so on you're doing subsequently, because that depresses the numerator. And you may make an acquisition and may do a lot more R&D or branding, brand building, and that depresses your ROA. So I'll throw that all together. It's not a measure of performance.
Regarding the kind of other half of the data, it all has to do with acquisition date variables. So we look at returns around the acquisition itself, broken down into positive and negative components. We consider a new variable, which is volatility. So we look at the standard deviation of raw returns of the acquirer for the year prior to the acquisition. We also consider kind of the percent of the transaction that is allocated to goodwill, as well as a number of other variables that are all tied to prior literature. Number of bidders, whether stock is the majority form of consideration. We look at market to book at the time of the acquisition, size, number of acquisitions the acquirer has made, relative price earnings, net equity issuance, whether it's a high litigation industry, and finally, a measure of due diligence.
James, Subda has a question in the chat box.
Oh, sorry, I'm missing the chat box.
It was just comment on Stephen's thing about the performance measure. I think you can say it's a performance signal or performance indicator without claiming that it's a measure, which requires more.
So I'm not sure if I can save the chat boxing, so that's why I'm writing stuff down. I think that is a great point, Sudipta. Thank you for that comment. Okay. Pam? I think you're muted.
Sorry, a comment that you made about the looking at the announcement returns. You do have, if I understood your sample correctly, you do have the change in when goodwill is measured midway through your sample. So in 2009, that return no longer affects the amount of goodwill, but previously it would have. Do you know what I'm saying?
I'm sorry, I don't think I'm understanding.
The FAS 141R changed the date at which the market value was used to compute goodwill.
Oh,
So if you're talking about looking at returns around the announcement date, that if there was a decline, that would have resulted in your having basically a day one goodwill impairment under the old rules, and that was eliminated under the new rules. And I think you have both rules in your sample.
yes. So I think we partitioned the sample around that and found
okay.
that there wasn't much of a difference in the results
Okay.
round.
Sorry.
No, that's a completely fair question, and that was something we considered. It must be in a footnote somewhere, and I've just forgotten which footnote it is, but that's an excellent point. Okay. So I've already discussed the sample selection based on Young's question. I know I'm running a little short on time, so why don't we try to get to the data sources and results. So in terms of mergers and acquisitions, our starting point was SDC. In terms of the accounting variables, those are mostly taken from CompuStat with a few exceptions that I'll get to in a minute. Stock price is taken from CRIS. This is also for a volatility measure. The SEC comment letters are taken from Audit Analytics, which is a very helpful data source. And segment level data was hand collected with a little bit of help, I must admit, from Capital IQ, which has a very neat way of kind of visualizing the data and allowing people to access the financial statements. And finally, the impairment and asset allocation data is all hand collected. In terms of the descriptive statistics, we spent a lot of time thinking about what is the kind of layout of the impairments, how long does it take firms to impair, and brought up a good point about immediate impairments. And we do find a surprising number of acquirers impair their target's goodwill right away. So basically first year, it's surprisingly high. Impairments are relatively high during the first few years, kind of peaking 2 or 3 years from the acquisition date. And after that, things kind of trail off. The other thing that we would like to highlight in our sample is we do notice that post the tech bubble and post the Great Recession, we do notice that the targets, the transactions don't tend to lead to goodwill impairments compared to the rest of our sample. So there seems to be some cautiousness after these recessions. That said, recessions do drive a lot of our results. To be careful, we do rerun everything, removing 2008 and 2009 goodwill impairments, and we find that our results are similar across the groups, though we do note that a lot of our impairments are obviously during 2008 and 2009. Most of the sample is made up of transactions that are within the same industry. So 80% of them are within the same FAMA French 12 industry classification. And there is quite a bit of clustering. So if it's the case that you're in something like finance or healthcare or energy, you tend to have transactions with firms in the same industry. Whereas if you're in something like durables or manufacturing, there's a lot more variation in who you're engaging in M&A with. We'd also like to note that the likelihood of impairing is going to vary depending on whether it is a within industry acquisition or outside the typical industry. And so it's going to be higher when it comes to the ones in different industries. I mentioned earlier that we have a model that's focused on just whenever the first impairment occurs, that's all we're interested in. We drop things from there. One of the reasons that we do this is because with the first impairment, a majority of the goodwill associated with the transaction is going to disappear. So on average, about 70% of the goodwill associated with the transaction is going to be impaired away. And so we have some concerns about following things beyond that because of materiality. Are things going to show up if there's really not much left in terms of goodwill impairments? We do follow that, and it's just kind of hard to tell going forward, given that these would be relatively small amounts. We do notice that among acquisition characteristics, returns around the acquisition itself, volatility, and the percent allocated to goodwill is going to vary quite a bit between transactions that do not impair and transactions that will impair. We note that volatility is higher. Also, the percentage of goodwill allocated to our goodwill number, that is also going to lead to future impairments. And there's some relations between our industry adjusted returns around the announcement window. We're going to use a slightly different announcement window compared to prior research. Specifically, we look at between a few days before the announcement date to the effective date. So it's going to be a longer window. Results are going to be similar if we were to use a 3-day one. But we found some interesting results when it came to this longer window. Specifically, it's the case that we find a strange U-shaped relationship between returns and likelihood of impairment, but that this relationship disappears when we include volatility. So this volatility measure kind of explains an odd relationship between returns and likelihood of impairment. Moving on to our impairment model, looking at market to book. So we expand the traditional definition of market to book. So if you include more indicators for market to book just above 1, it's going to drastically improve the predictive power of the model. So if you look at the area under the ROC curves, they are going to go up compared to not including those. Also, all of our indicators are highly significant. So there we're seeing that these are going to be relevant for our model. The other thing to note is we don't really see much of a difference between using a continuous variable for market to book versus an indicator for between 0 and 1. Where things really start to improve is when we're including these additional indicators of market to book just above 1. It's not necessarily here in any of the tables, but once you get past 1.5, we're not seeing really any improvement going forward. In terms of our segment data, we don't see an improvement in the models if we use segment level data as opposed to firm level data. This was a little bit disappointing. We were kind of hoping for different results, given that so much time went into hand collecting these segment level data, but they are what they are, and hopefully we're going to save some time for future researchers in the area. In terms of our predictive model, so we're basically going to use our kind of full equation here, kind of all the variables that we found useful. We're all using the segment level data, and we're going to use that to put together our prediction model. And so we're going to use a cutoff procedure from Palupu 1986 to break up our model. And so we're going to categorize it into should impair, probably should impair, probably should not impair, and should not impair. And so we're going to focus on situations where our model is indicating should impair, so kind of the highest likelihood of impairment. And so if we look at that, we're going to focus on things at the transaction level and follow through from there. So of our 893 transactions, our model is indicating that 349 of them have at least one should impair. And so what we're going to do is, starting with that first should impair, track what's going on. And so we have a rather detailed table that admittedly is a bit much to follow. So I'm going to try to take you through this with the last few minutes of the presentation. So starting all the way at the left, we have S with the superscript 1. This indicates the first time that a transaction should be recognized. So 349 there. And then we track for the first year, is it the case that the acquirer actually follows through with what should impair and actually impairs? And so as you can see in the next column over, we have S superscript 1, I superscript 1. That's indicating that a firm should impair and immediately does impair in that first year. And so 51 firms do that. And then if we look at the other box in our second column, we have S1, D1. This is indicating the firm should impair but does not. So we're just breaking up that 349 depending on whether or not that firm impairs. Admittedly, if we just look at year one, it seems like the compliance rate is quite low. So here, 298 firms don't seem to be following what they should compared to the 349 firms overall. We end up with a compliance rate of 15%. So the non-compliance rate is 85. So that must mean our compliance rate is 15. If we give the company a little more room and say, well, maybe it's the case that there was a temporary decline, maybe the manager had some indication that things are not as bad as the market realized, let's give them a little bit of leeway. And so here we're viewing non-compliant ones as firms that should have impaired in year one and should have impaired in year two, but didn't impair in either of those years. So if we do that, there's 113 firms that seem to be misbehaving compared to about the 350 that we have in the sample that should impair. And that's going to lead to a non-compliance rate of 33%, which would imply that 67% of firms are complying. If we extend this out to 3 periods so that firms can be completely sure that they should impair, our compliance rate is going to jump up to 85%. So there's only 49 firms out of the 350 or so that are going to be constantly in the should impair category and choose not to impair each of those 3 years. So we view those as problematic, but they make up only 15% of the group, which implies a relatively high compliance rate of 85%. I know I don't have much time left, so I just want to highlight the role of the SEC comment letters. Admittedly, we're providing you compliance relative to the rest of the sample, and so it would be nice to have an external benchmark. And so to do that, we look at SEC comment letters, which we pull from Audit Analytics. And so if you notice, there's a percentage in each of those boxes, and that indicates the likelihood of receiving a goodwill letter from the SEC. And what we're going to notice is that the odds of receiving a letter from the SEC about goodwill are going to be much higher if you're in the should category compared to the should not impair category. And while it's not shown for our first box, we note that the percent there, 13.47, is almost double what it is for the rest of the sample, which would be about 8%. We also like to highlight that the odds of receiving a letter increase the more times the transaction is categorized as should impair, but the firm does not impair. We also kind of take this as a broad view of the kind of how the SEC looks at things. So reading the letters, we find that the SEC seems to be okay with people or with firms using their discretion or judgment to defer impairments by underweighting current period performance declines. So there's significant anecdotal evidence if you read through these letters that while the SEC does regularly question fair value calculations and the assumptions that underlie them, these regulators generally stop writing if it's the case that managers claim there's significant volatility or that the stock price decline is due to some sort of investor overreaction. And sometimes managers are even going to pull sell-side analyst price targets and things like that to justify why that's the case. And it seems to be effective in getting the SEC to leave them alone. Admittedly, the SEC questions do become a lot more pointed when there are multiple periods that a firm is in the should impair category and doesn't. So it does seem to be that the SEC doesn't give up. It only gives up if it's the case that managers can make a kind of good argument about volatility or a temporary stock price decline. I think I'm almost out of time, so let me go to my conclusion. So we're attempting to provide a fuller picture of compliance with goodwill accounting rules under the current regime to help inform regulators as well as financial statement users about compliance with this rule. And so I was thrilled with Anne's comment that at least the international regulators are interested, but FASB may consider this again, since it seems to be something that comes back every few years. And we're also hoping that the paper informs researchers about how to effectively and efficiently approach research design in this area. Hand collection is valuable. Kind of more can be made of the book to market ratio than done by previous research, and also hopefully can avoid the pain of tedious hand collection for segment level data. So big thank you to Young, as well as to the moderator, and thank you all for coming to this presentation. Your comments are very much appreciated. And I wanted to make everybody aware that we have, or that Young and this project are going to be hosting another event on Thursday, May 4th, from 11 to noon. Alina Lerman from University of Connecticut will be continuing discussion of impairments, but here it's going to be impairments of investment securities for non-financial firms. Thank you very much.
Thanks, James, for the great presentation and